All right. Hanging out with Jared. We're doing a pre-market kind of rundown. We're actually getting toward the open. It's actually 1 minute past the open, so technically it's the early market. Let's go ahead and talk a little bit about the risk sentiment in the market. So, Jared, if you want to take it from here.
Yes, good morning, Daniel. So on Kovacs.tech, we have the riskogram that shows the current market sentiment, and currently we're looking at a risk on of 17.5. The higher of the three numbers. The risk off is at -3, and the neutral is at 3. So currently we're sitting with a risk on market. Now, to read the first most recent headlines, we have Adobe's 20 billion Figma deal set for full UK antitrust probe. So here you see that we're getting some global economic news in. Then to touch base on some oil trading higher, but remains on course for fourth consecutive quarter of losses. Interesting to note that oil is trading higher, but is still coming in with some losses there. Fidelity Sustainable High Yield ETF declares monthly distribution of $0.265, so 26.5 cents there. Okay, and then also Fidelity Tactical Bond ETF declares monthly distribution of 20 cents. All right, and
so if you see the one downstairs, Dow Jones futures rally 200 points on cool inflation data, that is something that I want to talk about. If as you see, if you notice right below that headline, it said that it affected USD, gold, bond stocks, pretty much the whole gamut. The reason why that's important, this risk sentiment tool not only tells you what the risk sentiment is, but it tells you what products it affects. And it's highlighted in like a deep burgundy color, which is telling you it's an important headline. PCE came in weaker today than expected, which the markets are interpreting as a good thing. If you recall, the Fed has been very hawkish lately. We're talking about two rate hikes at least after this little cooling period that they gave us where they held. So the fact that inflation is cooling is going to support their decision to taper the rate hikes. So that's a very important factor in the market. Other than that, we had some good news with some of those ETFs, like Jared said, paying distributions. That's always a good thing. And let's see, what else was in the news? There was something major that the markets were looking at. Anyway, it'll come to me. Let's go on to some charts. As you see, the risk on sentiment in the market, like I said, is pretty risk on. So let's see how that is reflected in the charts. So now I'm sharing in. Okay, so here we're looking at this is bonds. Okay, so the 10-year Treasury note. If you look before, for the previous week or so, we've been a little bit longer than a week. We've been holding the range between 112.25 and 113.12. You see, we have really good support here. Lots of green triangles on the KRI and red triangles on the KRI as well here at the upper bound. This is telling us that this range is pretty stable, and it was for over a week. We finally were able to break down. Jared, any comments on why this broke down here?
Would it have to do with inflation easing?
Well, that's actually over here. And the reason why this broke down, that's a good thought though. A lot of times you will see inflation data have a big impact on bonds,
Right.
because inflation, as we know, affects yield. by way of the federal funds rate, right? So inflation is going to impact what the Fed's going to do, and that's going to have its impact in bonds. This sharp sell-off actually came from hawkish comments from Powell, where basically he was kind of sticking to his guns on that two more rate hike, stance. And when that happened, obviously yields are going to spike because a higher Fed funds rate means higher yields. And as we know, bond prices are inversely correlated, or not inversely correlated, they are inverse to the yield, right? So basically, when yield spikes, that causes the price to drop. And
Right,
this
right.
it right here. So you were onto something here because that little pivot was the inflation, right? So basically, when that PCE inflation came across as weaker than expected, that basically is telling the markets, okay, our expectations for a Fed hike are that much smaller, right? Which brings yields down a bit. When yields go down, what happens on prices? They go up. So that's kind of what's going on here. We do have very strong support at 111.26. Again, this would be a good time. This would have been a good time to go long here. Probably a little bit stale in the trade right now. We're going to start expecting some resistance from 112.12. And if we can break that, definitely see some resistance at 112.25. So next one we wanted to talk about is stocks. This is, most most popular product to trade, the ES. This is actually the CFD product, the SPX 500. Very similar product. The levels are similar. As we have been covering in our reports, the S&P has been in a decline for the past 2 weeks, gradually breaking through these levels of support here. We finally found support around 43.50, and we're able to kind of turn the ship around here. We started to rally, breaking through higher levels. It does look like we're going to try to make an attempt to hit that high again. Again, that high was around 44.40. That's the level that we have. We're just a couple levels away from testing that right now. If we are able to, we should expect some resistance there. But if we can break through, the next target is 44.62. Any questions or kind of observations on that, Jared?
So after we exited the bear market and we were, on a nice decent bull run, I was looking at historical data that show that typically we had a 5 to 10% bearish retracement or correction, if you will, when we exited bear markets. So I've been discussing in our Discord, what levels to look out for as that retracement was expected. And historical data about the expected retracements that I spoke about, the only time that didn't occur was right after World War II. So obviously there were vastly different global conditions that contributed to that not occurring. But ever since then, it's been a consistent 5 to 10%.
Yeah, that's a really good point. And basically, what we're kind of hitting on is the concept of Elliott wave. So this is something that I teach in the classes. Elliott wave is basically a way that we can kind of encapsulate the behavior, the psychology of buying and selling and how the masses operate. So basically, it boils down to the fact that you have an impulse and a corrective, we call a wave, right? That's a kind of segment, if you will, of buying or selling. So on the impulse wave, that's going to be in the direction of where the momentum is. So if it's a bull rally, that's going to be your bull impulse wave. When you have that retracement, that corrective wave, that's kind of going to be in the direction, in antithetical direction. As we have profit taking, and momentum can't last forever, so eventually it kind of subsides. And that's basically what this maps out. What we see here is actually a pretty decent, what we call a
Yeah.
5-3 Elliott wave. Basically, I don't have, let me see if I can annotate here. So basically, we have something that looks like this, and then something that looks like this. All right, so we have 1, 2, 3, 4, 5, 1, 2, 3, and this, I don't have the Fibonacci tool, but I guarantee you this is going to align with the Fibonacci levels if we draw them. And then after that, we have, a nice impulse after that. So it it's difficult to kind of ascertain exactly what's going to happen. My guess is that we'll make front highs at least, probably form a range and maybe extend a sideways correction. Because the Fed is still, all eyes are still on the Fed, right? And in the type of economy that we have, basically the Fed is the only tool, or at least the primary tool, I should say, for market rally. So if they're still hawkish, there's still going to be pressure on the markets. Obviously, eventually that'll be priced in, but I don't think that we're going to see anybody pop the bottles anytime soon until the Fed can definitively say that their rate hike trajectory is over. Um, so
Okay.
again, I think that what we're probably going to have is a sideways correction, probably some resistance at 44.40, and an extended, like I said, sideways correction. If we can break through, 44.62 is the next target. You'll know by basically keeping your eyes on the KMI, the Kovac momentum indicators down here at the bottom. The blue line is showing a um, more longer term momentum. Basically, it's kind of confirming that what we're seeing here is indeed, something to look at. If the KMI here were flat, so watch momentum indicators were flat, there would be a high chance of this kind of rejecting, right? But I think that we should at least try to make it to highs. Um, and then, like I said, if momentum to continue, 44.62 is the next target. If we reject, there are some targets underneath here. So we have 44.08. Again, 43.50 down here is a pretty auspicious target. There's a vacuum zone below to 43.27. Those are the levels you want to keep your eye on. We could, it is possible that we form a very long-term kind of range here and just keep ping-ponging back and forth between those major levels. So we're going to see, keep your eyes on the momentum and the news. And we'll see, if we'll see what that has in store for us, especially on the data. The Fed has been citing the fact that inflation is still not where they want it to be, and it's likely that inflation is here to stay, right? Even if inflation falls from 4% to 3%, those prices aren't going to go away. You're still going to be paying like $10 a carton for eggs. It's not. It's going to be getting worse at a lessening rate, right? So all this is here to stay.
Yeah,
So
that's
any thoughts?
sure.
Any thoughts, Jared?
Yeah, so currently the Feds have chosen to pause interest rates, but I believe there still has been some hawkish rhetoric from them. Now, obviously, you don't have a crystal ball in front of you, so no one can say for sure, but do you feel like in your 20 plus years of watching the markets, there's a chance that they might raise rates again?
Yeah. So they have signaled that we have two more rate hikes in store for us. So that's probably two more rate hikes at 25 basis points or 0.25%.
Yeah.
We have at the next meeting and then the one after that, right? So we should have one in July and then one, I believe, in August or September. I have to check the calendar. So that should be the one. Those are the ones that we want to look out for that rate hike. Those rate hikes. Again, that's not necessarily a bad thing as for the markets. That is, as we approach those rate hikes, we're going to see more forward guidance from the Fed speakers, and be able to price those in. They don't like to surprise the market, and they'll give us some advance notice. So good question on that. But yeah, we can, as far as the latest from Powell, we should be able to expect two more rate hikes at 25 basis points.
So with all eyes on the Feds, would you say that whatever the Feds decide to do or how they speak, whether it's hawkish or dovish, that currently the Feds are the largest movement of the S&P in most markets?
Yeah, the central banks drive the market, right? Because their interest rate decisions affect everything. Any debt product is going to be tied to the Federal Reserve. I say that for the U.S., but in general, central bank. So when those rates move, the 10-year, the 30-year, all across the board, the bond yields are going to move, which is going to impact mortgage rates. It's going to impact
Yeah.
loans. It's going to impact uh, credit card APRs. It's going to impact everything, right? So that is going to take its toll on stocks because as rates get higher, that means money is less free. We had a historic period of 10 years where money was effectively free, where the Fed funds rate was sitting at zero. 2008 to, I believe it was 2018 was the first Fed hike. I'll fact check that, but it was almost a decade, right? And, when the Fed funds rate is zero, that doesn't mean there's zero cost or zero yield or 0% that you pay to the bank. That just means that it's going to be a lot less than it will be with the Fed funds rate around 5, 6, 7%, right? You're going to be paying closer to double digits in a mortgage with Fed funds rates that high. So that means money is less free. That means tech stocks are going to have be strained a little bit more for the R&D to make tech products. That means banks are going to be strained a little bit more for who they're allowing to get loans, right? So those types of industries tend to suffer a little bit more than other industries that are less sensitive to interest rates. Everything is sensitive to interest rates in some way, shape, or form, but some a little bit more resilient, including like energy utilities, those types of things. People still are going to build, and those are the types of things that are stronger in the recession. So anyway, real good questions there. We can move on to the U.S. dollar. Sorry, actually, this is oil. As Jared mentioned before, oil still closing lower, but it seems to be trying to eke out some gains here. If you guys were reading in the reports, we highlighted 70%, $70 as a good target, where we're going to probably meet some resistance if we can break through that 71. And as you see, we started meeting resistance here at $70, confirmed by these. Let me get the drawing tool here. Confirmed by these two red triangles on the KRI. Then we were able to kind of break through. We kind of peaked here close to $71. Didn't quite hit $71. So basically, the reports were perfectly in line with reality. We do see this gradual upward trajectory here on the Kovac OBV. And if you notice here, we have price action rounding off. So, Jared, if you were to think based on all these factors, what do you think? What do you think is going to happen with the price action?
Well, primarily I would go off of the Kovac momentum indicators. The OBV seems to be rounding off. Based on that, and it looks like the volume is rounding off as well. Would it be looking to trade sideways for a bit?
Yeah, that's what I think. We're looking at either a sideways period where we can kind of establish value here, or we could expect a little bit of a retracement, potentially testing 68.97, 67.91. And I believe that the floor here is probably 66.77. That's the lower bound right here. We have strong support from a relative low and a green triangle, on the KRI, kind of confirming that. So
Very strong
that's it.
resistance around that point, with those other dips monthly. No,
Yeah, yeah, absolutely. So basically, we have this guy here, and again, the third confirmation. That's a good point, Jared. Is like historically, what is the best predictor of future
support.
behavior?
I just say support.
Historical, yeah, exactly. So
Um,
the best predictor of future behavior is historical behavior. So we have some historic examples right here, here, and here of support in oil. It's a good observation.
yeah, I think
Uh,
you mentioned pretty strong resistance, most recently with those red triangles between, the
yeah, right
9.
here,
Yep.
right here. And don't forget, this is $70, which is a nice psychological and technical level. So, and we see that in the past, right? We saw it took some big momentum here to break through that. We were struggling here in this area. We tested this a bunch of times, just couldn't get through. Nice rejection here. Also, this was kind of a if you recall from the reports, this was a head and shoulders breakdown. So if we draw the head and shoulders pattern here, uh, inverse head and shoulders. Basically, we have the neckline over here at 70, and again, historical resistance from this level, which we would anticipate being a psychological level as well. And in fact, we rejected it. That's a very bearish sign, right? And in fact, we were able to establish a low just below our head, and that's what we can expect off of an inverse head and shoulders breakdown. We see this breakdown coming here, extending past the head of the inverse head and shoulders, falling to a good level of support. Again, I've highlighted this guy 66.77 in the reports, good historical examples of support here. And then we rebounded, and tested 70 again. So 70 and 71 are going to be formidable levels. It's going to take a lot of momentum to break. I'm not entirely sure that we're going to be able to do that unless the Saudis follow through on their word of cutting production. So right now we're for oil, we're looking at a lot of resistance here. So again, probably can anticipate a range forming perhaps between 68.96 and the low 70s, 70 and 71. Lower targets for support, 67.91 and 66.77. Again, as Jared pointed out, that is that historical level of support here that we've been seeing since for all month, basically. Any more thoughts on oil, Jared?
Not at the moment. I mean, we see the historical levels of support. Like you said, 70 is a technical and psychological level. That's a great point to make, especially the psychological point, because it is obvious that it's a technical level of resistance. Also looking at the historical data. Um, no, I mean, other than that, throw in some of the fundamental analysis, like you said, with what the Saudis are supposed to do. And yeah, to me, I don't have any more questions at the moment.
Cool. All right, let's move on to the US dollar. Okay, so the US dollar,
Jay said he's logging in.
yep, we'll see him in a second. Okay, so the US dollar kind of tested lows here. We were looking at the 102s. So 102, I'll probably add that as a technical level to the chart. It's definitely a psychological level here, but as you see, the technical price action is respecting it. So therefore, we can kind of add it as as another level here. As as the U.S. dollar started to unwind. Why did the U.S. dollar start to unwind? Well, after the most recent federal FOMC, we kind of paused the interest rate hike. um, interest rate hikes. And so the dollar was kind of looking at unwinding because without further hikes, dollar is tied to the uh, federal funds rate as well because yields are tied to that, and bond products are bought in the U.S. dollar, right? So that is going to impact the U.S. dollar. It has been very strong when the Fed was historically um, did their historic interest rate hikes. We were basically on par with the euro. In fact, the euro dropped below par for a little bit. And now that we've kind of seemed to at least be close to peaking out, if not peaking out, we can start to see the dollar unwind a little. So we sold off basically from the 104s here, the high being just above 104.53, our level here. And we basically had a solid downward trajectory, found support here at the in the 102s. And then, after the Fed kind of equilibrated a little bit and started to discuss, the interest rates and their continuation of the campaign, we started to kind of lift a little bit here. Obviously, this rejection, the most recent this morning, came from PCE when we saw that inflation came in weak. Basically, what that's doing is, again, with weak inflation, that's what the Fed wants. If inflation is weak, that means they have less likelihood of raising rates. At least that's how the markets view it. And so that's why we had our little rejection here. If you have been reading, you rhetorical, I know Jared reads them, but if you read the reports in the morning, basically we highlighted this level. It's on the charts, but we highlighted it many times. 103.50. That is a very strong, very auspicious level for the dollar. Again, how do we measure that? Well, historical adherence to that level, right? We have a couple examples here of us testing just a little bit below that. The U.S. dollar can be a little bit noisy with the volatility, but basically it shows that we're kind of testing somewhere very close to this level. Have some congestion area here, and it's kind of lending credence to the fact that this level is something we should be looking at. And so if we rewind the clock to 8:30 when PCE came out, if we're sitting here testing this level and we have weaker inflationary data, what's the chances that we're going to break out? None at all. So basically, this rejection was imminent. Any questions on the U.S. dollar?
Yeah, like I have a decent understanding, but would you clarify a little bit about how the US dollar is expected to react when inflation is climbing or rising, and also how the US dollar is expected to react when the Fed's hike or lower rates?
Yeah. So what you need to be thinking, hey Jay, what's up, man?
Sorry, guys.
Good, man.
Good to see you, bud.
Yeah, good to see you guys.
Yeah, so we're just kind of doing a little recap of the market action. We talked about stocks, bonds,
Okay.
oil. Right now, we're talking to the U.S. dollar, and the next thing that we're going to review is Bitcoin.
Huh.
So, talking a little bit about what's going on right now with inflation and the Fed and stuff like that. Jared asked, how does the U.S. dollar react with inflation? How does the U.S. dollar react with Feds? And I think what we need to be focusing on is how the U.S. dollar is affected by yield, right? When the bonds when bond yields get higher, investors obviously want to enter, buy bonds for that yield. How do they do that? They have to do it with the U.S. dollar, right? You can't buy U.S. bonds in terms of euro or whatever. You have to convert it into the U.S. dollar first, right?
Right.
So that's why the U.S. dollar tends to rally off of higher yield forecasts, right? Whatever is going to make that higher, be it the federal funds rate in terms of a hawkish Fed, or whether it's inflation. If inflation picks up, that means yields have to pick up because your debt denominated products are going to have to compete with inflation. Additionally, the Fed typically gets a little bit more hawkish with higher inflation. That's not just now, that's in general. And the reason is they don't want the economy overheating, right? So if inflation
Right.
is higher, that means that they're going to increase rates in order to try to keep that suppressed. Obviously, inflation is a very dynamic thing, something that you can't always rate hike away, but these are the tools that we have available to support our Fed, has. So basically, we saw this nice sell-off here from highs around 104.53. Basically, that followed after the Fed kind of equilibrated after the most recent FOMC where they decided to hold. We can start to see the dollar kind of unwind a little bit. The dollar has been showing historic strength, especially with their previous rate hike campaign where we were on par with the euro for a little bit. Again, what I'm by the way, I'm saying the U.S. dollar. This is actually the U.S. dollar index. It's a weighted index of the U.S. dollar against a basket of other currencies, mainly being the euro, but there's also the British pound, Swiss franc, and the let's see what else. Uh, Swiss franc, British pound, euro, and the Japanese yen, I believe. So might have to fact check me on that basket. I might have left something out, but anyway, this is an index, and it's kind of like a broader measurement on how the U.S. dollar is doing. So then the Fed all of a sudden kind of mentioned to us that we probably have two more rate hikes in store, and we started to see a little bit of a rebound here in the dollar. Right here, 103.50. That's a level that we've been highlighting in the report. This has also coincided with when PCE came out. PCE came in weaker than expected, so the dollar sold off. Basically, that's what we're looking at here. And any questions on that? U.S. dollar, how it reacts with inflation?
No, I think that was pretty clean explanation.
Cool. All right.
I find that like understanding the dollar has probably helped me more than anything as a trader. Like you said, it kind of is the cornerstone of it all.
Well, the cornerstone of it all is actually bonds.
Yeah.
Because
Yeah.
bonds are kind of like the engine of the market, right? Because they're directly tied to the economy. So when something happens in bonds, you're going to see a reaction in everything else, right? So a good example is right here. We see this little sell-off here in bonds. That's directly correlated with this buying in the U.S. dollar, because bonds are not correlated to yield. Bond prices are the inverse of yield. It's a mathematical thing. There's no arbitrage or anything there. It is a mathematical calculation based on the bond. So if we know that the U.S. dollar is correlated with yield and bond prices are dropping, what's going to happen with the dollar? So very, very clean signal here as bonds broke through. I've been talking about this for weeks in the reports, this range here, how that's not going to last forever. And sure enough, we broke through and that's the close here. So really good indication that the move. And basically now we're in a position to start talking about crypto and Bitcoin. So Jay, any thoughts here?
Well, the BlackRock, the news today was that the BlackRock ETF got denied.
Oh.
Well, they said it's not adequate, which I read as denied, but I don't know what that means. Or that the application was not adequate. However, I think that, and I know that, Daniel, we discussed this prior in your reports as well. The warning signs were there. I mean, it has been, fairly overextended for some time, and there's been a lot of kind of late leverage and late longs piling in. So,
yeah, that's a really good point. So let's talk for those of you. I'm FYI, I'm recording this and gonna throw it up on YouTube after. So for everybody
no worries.
who is not familiar with why this happened, basically BlackRock announced a spot ETF. Why is that important? because number one, an ETF allows common stock investors to have access to a thing. So if you don't want to, buy 100,000 barrels of oil, you don't want to actually go to a farm and buy hogs, you don't want to sign up for an exchange and buy Bitcoin, you could have access to all those things through what we call ETF, right? And this is a very strong sign if there's ETF interest in Bitcoin. Basically, that shows institutional interest in crypto, right? So if we start seeing an ETF, what does that mean? That means that, especially a spot ETF, all ETFs, at least in the US, that have been announced for Bitcoin or crypto have been derivatives based. That means you don't actually have to really own Bitcoin. It's kind of a paper Bitcoin, if you will. But with a spot ETF, you're going to have to own a certain amount of Bitcoin to back that up. Now, BlackRock wasn't the only one. I want to say Vanguard and another one that announced.
I think Fidelity, but Fidelity was, I think this week they threw their hat in the ring. But yeah, there's a couple.
So there's definitely a couple, and what that means is that institutions, TradFi, if you will, are really looking at this. Okay, so if there's interest in a spot, especially a spot Bitcoin ETF, that means that these institutions are going to have to accumulate Bitcoin in order to have something to back up their ETF. So hence why there was all this kind of buying pressure, and of course, the retail is going to pile in after hearing that news. However, after that was announced, we were kind of left hanging. As Jay mentioned, that was, we had reports that was inadequate, their application, which could mean a lot of things. It's non-trivial to launch an ETF, as you could probably imagine. There's a lot of paperwork, and you have to prove that you have what you have to back up what you're saying that you do, and it's pretty intensive. So, granted, BlackRock should know what they're doing, but still, I wouldn't say that's the end of the world, but it's definitely not the news we were hoping for. And yeah, so we basically have this range here that's been holding for basically since the 23rd, so about a week. And when the longer Bitcoin holds a range, or crypto in general, the downside risk is a lot higher than the upside risk. Just from, especially now in this time frame, if we can't hold a value and keep moving or keep mooning as we have in the past, that probably means that we're going to reject and head to lower levels. That's just what we've seen in the past, and that's kind of what I foresee anyway, unless we can get some positive clarification on these ETFs. Probably eventually going to test down here back to 28.8 at least. There's a nice vacuum zone here, which Bitcoin does not spend a lot of time in. After we shot up from these lows here at what is that, 25.1K. That was kind of the relative low here, able to shoot up all the way to 30,000 handle, which was a big monumentous occasion, I guess, for Bitcoin. And basically we're holding the range here, kind of holding the fort down. But like I said, if we can't get the momentum to hit this next target here at 32.3, so 32.3 thousand, then we're probably going to retrace a little bit, or at least that's what I kind of see for. That's a downside risk. So if you want to trade this, I'd look at this range here between 31,000, 30.2K being the lower bound. Kind of see this ping ponging here back and forth. Range trading is always great until it fails. So we've been seeing this happen for over a week now. So again, the longer we hold a range, the more likely a breakout is going to happen. Any thoughts on that, guys?
When was the last time Bitcoin was at these levels?
I believe it was 11-month highs, I want to say, this 30K.
Yeah, it tapped, and I mean tapped 31K at the beginning of April, and then pretty much, that was the top. And it was, I mean, I think it probably spent 48 hours above 30K back then.
Yeah, and then it immediately retraced and kind of felt out the mid to upper 20s. So yeah, well, I want to say it's been like 8 to 11 months since we've seen these levels like sustained. So the fact that we've been able to kind of keep it here is a good thing. But like I said, it's gonna start looking top heavy. It's gonna start, as we see here, we have some good momentum with the KMI here. And eventually, things are just going to retrace. It's due for a retracement anyway. We had a lot of strong buying here without any kind of retracement. This is technically a sideways correction. So we can either have this corrective wave, which tests lows, or we can have a sideways correction. So it's not out of the realm of possibility we could break out again. But like I said, downside risk here. If you're looking at going long term, I'd be looking more to load up right here, just because it's likely that we're, like I said, downside risk.
I agree with all of that. I mean, and to the other thing, Jared, back to what you said, like, we haven't traded above this level since May of 22. So like Daniel said, a little over a year. And I think, like, historically, when we had that huge sell-off a few years ago after the Coinbase public offering, it sold down to these prices, and this is where it bounced from. So it's a pretty, like, long-term, support resistance level.
Right. Okay, that's important. Yeah. Because the all-time high was December 2021.
Yeah, maybe November. It might have been. I think it was November.
Before then.
It was. Let me see. The week of November 21st.
Okay.
69,000.
Yeah.
Yeah, we should be seeing resistance from these highs. This is not only a psychological level here at 30K, but like Jay mentioned, we saw some resistance there in the past, weren't able to sustain those levels. So what's the best predictor of the future? History. So it's basically showing that, confirming anyway, that we have that these low 30Ks are particularly auspicious level. If we zoom out and we do some Fibonacci's, we actually see that corresponds with a very strong Fibonacci level on the daily chart. So again, lots of factors suggest that we have some resistance here, and that it's going to take, some pretty formidable news to break out. Like, if you guys remember when Bitcoin was like, this was a few years back, after the last halvening, it was still hanging out in like the 10Ks. And I believe that was what kind of broke that was Elon Musk. Remember, he went on this tirade about Dogecoin and Bitcoin and all that. And he's the influencer of influence, right? The guy owns Twitter, and I think he bought it just to support his Twitter addiction, right? So the guy's just like the biggest influencer, right? Maybe besides Joe Rogan. So when he's touting it, then yeah, everybody piles on board. And we saw that rally to the 60s, mid to upper 60s. Eventually, we should see that again after the halvening. It'll likely be realized by somebody like him saying something funny, or an ETF going through and institutions are clamoring on board. So we'll see what that is, but I just don't think that we're ready for a sustained rally yet. If anything, we may test 32.3, but I'm not kind of getting my hopes up yet for it. I do believe it'll happen. Is it going to be now? I mean, based on the technicals, everything that I just mentioned, probably not.
I agree. I mean, I think the thing I trust more than anything with this stuff is the 4-year cycle that it has stuck to, and you look back at history, and again, there'll be news and events like you kind of mentioned that will come up and confirm, analysis and support it. But it's I mean, the times like it bottomed out last cycle, and I understand there was COVID and whatever, but it didn't bottom out until March, right before the halving, and that was like Bitcoin was at like 3,500.
Well, when you look at when it bottoms out, basically you need to look at miners, right? Because miners are paid
Yeah,
in Bitcoin, and they're going to
right.
start taking profits at highs, right? They're going to try to get the most out of their money, and at the end of the day, it's USD that keeps the shops open. They got to pay their energy costs, right? So they will tend to start selling out mid cycle, which is why we
Yeah,
tend to see mid cycle. It'll take us down to lows, then they've taken profits already. They kind of ease up the gas a little bit, and Bitcoin will kind of equilibrate. And that happens like clockwork right before the next halvening. So we got one coming up in
yeah.
2020. I forget when exactly, but it's in
May.
2020.
It's like roughly the second week of May.
Yeah,
But it's a block number, not like a date. So
yeah,
I think
exactly. People don't
there's like a
understand.
degree of, yeah, there's a little bit of flexibility.
Yeah, halvenings happen at a block number, not at a specific date, because that's just how the blockchain works. And it tends to be pretty precise, but there obviously is some leeway. By the way, did you guys check out Litecoin? Litecoin rallied to
Yeah,
100.
I saw. Yeah, and
And
freaking Bitcoin Cash is up
oh,
like
I heard that
20%
too.
today.
Yeah, I heard
The
that too. I don't know if it's,
has tripled, has tripled, gone from 100 something to 300 something in the last month.
yeah, I did. I remember hearing about that. I don't know the reason why. If it's a similar thing, like the new Litecoin rallied because it got a new or reached a new difficulty in the hashing, right? So the
Yeah,
hashes per second, has increased the highs, which obviously makes the coin more valuable. I'm not sure what the reason for the Bitcoin Cash thing is.
yeah. I don't know either. I have never. I mean, I guess I got Bitcoin Cash, back however many years ago when they forked it, and I pretty much sold it that day, and that was my Bitcoin Cash experience. So I'm really not, I'm not. I
Yeah,
don't
I'm
know
not
what.
a. I remember looking and just seeing like it was like 3 grand of Bitcoin Cash I made from the fork, and I was like, okay. And whenever I see that, I always take profits. Like, you know how crypto is, right? You see it in your wallet one day, and then the whole and it's gone, right? So if I see
Yeah.
a substantial amount from a drop or anything like that, I always take it immediately.
Well, and the craziest thing was, I don't remember. I think the Bitcoin was maybe like $3,000 or $4,000 back then. But if you went between the BTC Bitcoin Cash ratio, it got up to half a Bitcoin per Bitcoin Cash, and it's fractions of that now.
Yeah, that's crazy. So yeah, that is something that is common, right? And that kind of really supports my point on you ever see crypto in your wallet, especially if it's new, probably a good time to take advantage of it because long term,
Yeah,
and this is just a word of advice for anybody looking to capture the latest meme coin or whatever, is that nothing will outperform Bitcoin long term. And that's just a historic fact. Bitcoin is the flagship crypto. That's where TradFi puts their money in. Other cryptos can have strong arguments, but nothing can really outperform Bitcoin long term. That's just a historical fact.
yeah. I mean, and it's I think for me it's this. I mean, by far the safest, most liquid bet in this space because you know what it is, and its use case and value proposition is more in scarcity and the known supply schedule and things like that. I think a lot of other crypto tokens are more dependent on ecosystems developing around them and people building cool stuff, which you get the best and the brightest working on that uh, I'm sure they'll figure stuff out, but that's, kind of a risk factor that,
Yeah,
uh,
that's a really, really good point, is like where crypto derives its value from. And Bitcoin is very clear about that. I don't necessarily like using it as a currency. For that, like for example, Litecoin, that's why I still cover it in the reports. I feel like Litecoin has a future as a currency. It's already integrated into MoneyGram, for example. Integrated it, that's when it shot up from like $30 to like 80, basically overnight that one time. But other than that, my solid number two for crypto is Ethereum, and that's basically for the reason the what Jay mentioned, because Ethereum actually supports smart contracts, which is, you know, a fancy way of saying that you can make little computer programs run, including NFTs, voting mechanisms. You can do a lot of stuff with Ethereum. Ethereum's certainly not the only smart contract. There's other ones out there. A lot of really cool, innovative stuff happening. But again, like Jay mentioned, it's dependent on an ecosystem, right? Ethereum is the first. As the first, it's certainly nowhere near the best. But like I said, it's the first. It's what everybody knows. So I think as a solid second behind Bitcoin, you're going to have Ethereum.
I agree.
So
And sorry,
essentially, Bitcoin is going to remain the gold standard.
Yeah, yeah.
I believe so.
In fact, I like to analogize Bitcoin as digital gold, right?
Yeah.
Is it something like do you go to the coffee store and pay for your coffee in gold? I mean, I'm sure if you handed the dude a gold bar, he certainly wouldn't turn it down, but that's not the point, right? The
You're not
point
going
is
to shave off part of the gold bar to buy a coffee. But what's amazing is like if you move to another country, you're not going to be lugging your dozen gold bars with you. You can just pull your Bitcoin out.
well, yeah, and that's kind of the analogy, right? It's like Bitcoin might not be
Yeah.
the best, most efficient way to pay for things, but it still has value and it's still recognized, right? It still has recognizable value for basically anybody in the world. At this point, the entire world knows about Bitcoin, right? They know what it is, right? It's not 2008 anymore. And so people understand what crypto is. They understand the perceived value of it. Whether they choose to partake in it or not, that's their decision. But, some people don't like metal. Some people wouldn't buy gold, right? So it's the same kind of thing going on there. But, you know, again, if you had to, Bitcoin, you could obviously pay for things. It's just not the most efficient way to do it. I guess was my point from that gold analogy. But that doesn't mean that it doesn't have value, and the value is kind of locked up in a very similar way, right? So, again, you would pay for things with, something a little bit more modern. I know Ripple has been making a lot of advances into TradFi. Like I said, Litecoin. Those are my favorite actually pay for stuff. Fairly low transaction costs too, low gas
Yeah.
fees. Same cannot be said of Ethereum. Ethereum's like the highest. And Bitcoin, it's not horrible, but it's also not the best. And it can take up to like I've had Bitcoin transactions take up to a day, depending on how busy the network is.
Oh, geez, I forgot about that. Yeah, I haven't paid attention to crypto for a little bit because I've been so focused on the S&P. So it's really, I'm enjoying getting caught to speed with crypto between, what you two are saying. And I'm also really enjoying your insights on this, Jay. I mean, because you've been paying attention to the crypto markets with a magnifying glass for a while now. And experience really is valuable. It's not measurable on the charts.
Yeah. Well, I mean, it's been, I just find it fascinating because it's so fast paced.
Yeah.
Yeah, definitely. The volatility is incredible too. Right? You be in one mode, and then something happens, and instantaneously you're somewhere else. Right? It's just very, very fast paced. All right,
Yeah.
guys.
I mean,
Really good insights here. I think we're gonna wrap
yeah.
this up. Really
Okay.
appreciate you guys, stopping in, and we'll try to do this a little bit more often.